Welcome and thank you to everybody for joining us today. My name is Jill, and during this session, we're going to be presenting our latest income structured note for the year, which comes with deep capital protection as always. Firstly, Andrew, who heads up our product development and is also our technical expert, is going to take us through the thinking behind the note, and then I'm going to go through how the protection features work. Please feel free to post your questions in the chat as we go along. And for those that are new to structured notes and have any questions about how they work, just let us know in the chat again and we will arrange a coaching session for you. So before we begin, as always, today's session is to introduce you to this structured note opportunity and explain exactly how it works. It's not to be considered as personal investment advice. Structured notes, as you know, are not risk-free, and outcomes will always depend on the terms of each contract and how the markets behave. Always make decisions based on your own research and professional advice where needed. And then with that, I'd like to hand over to Andrew.
Great. Thanks, Jill. The team has asked me just to give a quick little recap in terms of we've arrived at this note, as you can see on the screen. And please feel free to read away. But in terms of how did we get here and why are we actually presenting this? So I think our last webinar of 2025 was really, I think Logan's around and available to pop the link into the chat group or whatever, in terms of what we expected to come out of 2026 in terms of the forecasts for what could be expected, I guess. And I guess given 2025 was quite a year of upheaval, we all went away in December. Well, not just after the webinar, but we went away in December for the sort of annual close down to take a breath, recharge our batteries, and to revitalize, and to perhaps consider, what is on the agenda for 2026. And quite a few points were raised in that webinar, and I'm not going to canvass them thoroughly. The link is there, or should be there. And I think what is important is to make the link between what was happening in 2025 towards the end of the year and what we all arrived at in the first 2 weeks of 2026, because it has been quite not a shock to the system, but we certainly woke up and had to sit up and take notice of things that were happening globally. And one of the issues that I raised at the end of 2025 was that geopolitical events, mainly dictated and overshadowed by what was happening in the Middle East, really dominated global politics and affected economics and affected our investments and our thinking in terms of what could have happened in that regional conflict that really started spilling over. And one of the little sort of points that was mentioned in terms of hotspots was that, yes, there was Taiwan, the ongoing Taiwan situation, the South China Seas, obviously the Ukraine and Russia conflict just staggers on from one season to another, unfortunately, with many people losing their lives. And we also pinpointed a sort of area that was building in intensity and in terms of potential threat, which was in South America, which was strange of all places because it's never really been on the map besides Cuba, and that was Venezuela. And we all know what happened when we arrived and woke up on the 1st of January, and the weeks that followed, the 2 weeks that have followed. It's been pretty hectic. The sort of gunboat diplomacy that was really a feature of sort of 18th and 19th century imperialism returned in US foreign politics in terms of leaders being snatched in the middle of the night and quite serious implications for what might happen in other areas of the world as in terms of setting a precedent. Needless to say, Venezuela has not, I won't say has come and gone. There's a lot going on as I look at my screens tonight that in terms of the leader, the interim leader, or it's not the interim, but Delcy Rodriguez, who's taken over from Maduro, is being invited to the White House now. So there's a lot going on. There's a lot of noise, there's a lot of anxiousness, there's a lot of volatility relative to oil, relative to energy, all sorts of things happening. Halfway across the world, China is ramping up exercises around Taiwan. Does this give them the opportunity to say, well, we're going to go march in there and take what we think is ours? And the rationale to this particular note, I do suggest, I saw it in the invitation, the 1 hour sort of countdown clock. have a read, because in there it really is quite a detailed note, easily read, I believe, in terms of what is actually spreading around the world. And geopolitics is really something that's driving US foreign policy at the moment, is really driving a lot of people into, well, hang on, let's get invested in this opportunity. And that's something that Cashbox has tried to veer away from, is the faddish opportunist situations. Yes, technically, if you're a trader, you can go in and out in terms of buy and sell very quickly, but then you need to be a professional investor, sort of kind of know what you're doing, and you're in there. What we are looking for, as Jill mentioned, it's predictable, contracted, defined, and for some people, maybe an area that's is not very exciting when you can make 40% returns in tech or overnight in one particular stock. That's not the nature of our particular offerings. And in terms of that, it's, one's got to be very careful in terms of investment approach. All these percolating opportunities that come out need to be assessed from a fundamental perspective. Whether it's a company that you're looking at, whether it's a sector that you're looking at, whether it's a geographic area, a commodity, any asset class, you've got to look at the fundamentals of, does it make sense? As opposed to, wow, this is all bright and shiny, let's jump on it as it passes by. Because often you might get caught into that trap where you're going to sit there for a number of months, a number of years, well, longer than you may have expected. So research is important. And that's what we set out to do for you in terms of looking from both a top-down and a bottom-up approach in terms of, does it make sense now? And is it going to make sense in terms of the term of the contract? So quite important in terms of having a sage approach in terms of, following the reasonable money, following the defensive sort of allocations. And you'll see at the end of the particular rationale that I've mentioned, I end it by sort of, the overview is like, you need to do diligent research, and you need to make allocations that are both defensive and that make sense to your own portfolios. Okay, so it was with that sort of depressing news I've now filtered out to you. We looked at that and said, like, right, for 2026, we've had a number of autocalls that have come into the space, and a lot of our clients were looking for income, specifically US dollar income. And in the past, sometimes our global banks have provided growth opportunities, but this particular note is, and thanks to Graham on IDAD, our structures, who we went out and we looked specifically for an income-producing note. So there you have it. It's income. It's hedged at 14%. So in other words, that's the contracted amount. It can't go up, it can't go down. 3.5% quarterly. We started this conversation, Graham and I started this conversation, and I apologize for, he probably curses me off air, but we started at about 13.2, and with lots of cajoling and discussion and arm bending and arm wrestling, especially from their side with the underwriting bank, which is BBVA, a large Spanish multinational global bank, tier 1 A-rated investment bank. We got it up to 14%. So 14% for a defensive sector like banking is fantastic given the current circumstances. The banks at the moment are not really sort of pushing out the boat, if you want to call it that, in defensive sectors. They'll offer you something spicy in maybe the tech sector, and we'll have a look at that in terms of how some of those companies are sort of within this AI bubble that people are talking about and getting a little bit concerned about. So this is a defensive. It's less volatile, maybe a little bit boring, but I'm going to show you some slides that will knock your socks off and make maybe your hair stand up. Say, wow, I wasn't there before. But before we go there, bottom right-hand corner, it's a health warning. It's the caveat that we always have to say. We are always only given a certain allocation of capacity in terms of the inventory that we order, that we hedge. That either goes before Thursday, the 29th of January, or it will expire. The offer expires on the 29th of January. We've had quite a lot of pre-orders being filled. There are a number of people on the call tonight who have put in their expressions of interest. We obviously looked at that to build the raise. It's a very, very solid and healthy number. We'll probably bust the raise, I believe, and so does Graham. But in terms of the dating, have a look at it and make your decisions rather sooner than later. So Jill will take you through some of the terminology for those who are new, memory, income, Autocall. I'm really here to say is why we've chosen banks at this particular time where there's so many exciting things going on in the world. So if we move on to the basket of the actual banks that we have actually considered. So not Lloyd's, I beg your pardon. Barclays, Société Générale, Commerzbank, and Goldman Sachs represent four major globally systemic important banks. By that, what I mean is they are important to both their region and to both global economic commerce and business. Some of them are household names. Some of them you might not be familiar with, but they're all very, very large. Three of them are obviously based out of the European area. Well, Barclays is UK, but Commerzbank Germany and Société Générale France represent that sort of part of the world. Goldman Sachs is the US participant. So there's a weighting towards Europe, and there's a very specific reason at this point. We've launched a number of notes recently, last year, that again had this bias towards Europe, and that bias hasn't decreased. The focus is still very laser focused in terms of European banks seem to have the edge over their American peers. Interesting because it's earning seasons at the moment. So in other words, what I mean by that is Q4, every quarter, the banks report, or in fact, all businesses report in terms of how well or how badly or what challenges they're facing from the last quarter and what their guidance is going forward. Now, that's very important. It forms one of the fundamental processes of understanding what the environment is telling you as an analyst or as a person who's making an investment. And today, Goldman Sachs had their earnings. We'll go through that shortly. The other three are still to come up. There's a slide on that. BBVA, the top left-hand corner, let's just get them sorted out. They're the underwriter, they're the guarantor of this product. We've done a lot of work, and I'd add our structures have done a lot of work with them over the years, 20-odd years, and certainly our 5 or 6 years of existence, we've done a lot of work with them. And you'll see from the next slide that we've certainly got a lot of banking notes that they've underwritten. They're pretty good in this area. So the notes that are underwritten and solid, has to pass muster from both their investment committee, from their credit committee, etc. So very, very happy that we've got a solid tier one investment bank. That's only what we look at to underwrite that. I asked Jill yesterday, I said, I love this, the analogy of a moat, like the old castle where you have a moat around your investments, which makes things safer. I've mentioned risk off. I mentioned less volatility in the banking sector. So I don't know if that's a moat, but then she's provided a super slide later. But that's a little bit of a moat. And obviously, it's a mishmash of buildings representing sort of corporate and banking global banks. Those are pretty much household names. The rationale deals with the actual companies in a more granular fashion. So if you want to dig deep and go under the hood, under the bonnet, so to speak, and understand what, for example, what Commerzbank do. How solid are they? I mean, the second largest bank in Germany, they're pretty much owned by the German government. One of the largest shareholders is the German government, looking after their sort of middle sector of businesses. So it's pretty much part and parcel of the German economic fabric. Very, very important bank. Société Générale, one of the big French banks. Barclays, pretty much a household name. And Goldman Sachs, one of the Wall Street titans. So we've allocated our exposure, and the bank has agreed to the exposure that our rationale, our story, in other words, the 14% that's tied will be tied to the fortunes of these four companies. So it's very important to understand how these four companies have performed, and more importantly, because they performed in stellar fashion in the last 5 years, but more importantly, how they're going to potentially perform in the next 6 to 12 months and beyond that. And we try, as I said earlier, to always make our notes applicable for a longer period in terms of the term. Here's some of the notes that BBVA have put together. We've got 1 or 2 running, new ones running. But you can see going right back, if you can make out the font, goes right back to sort of 2021, I think. So it's a long history in terms of the banking sector has been a very solid sector, been a very successful sector for cash box investors. And if you look at the sort of term period, they don't run to term. Many of them have run, as short as 6 months, some as long as 18 months, I think. So 15 months. So I'm not saying that's a guarantee that this is a short-term note. Some people say, look, I'm quite happy to get 3.5% for the next 4 years. Thanks for coming. But the order call is there. It's a feature that's built in. It allows the bank to actually call the note and exit. And it also gives us a liquidity option, 6 months, 12 months, 18 months down the line to move on. So let's look back 5 years. I just made mention of the fact that European banks have done so well. Well, I mean, you can read it for yourself. I've included their 6 indices, starting with the American S&P 500, sort of the broader American market, the NASDAQ, which is the tech-heavy sort of index, the Dow Jones, which is the sort of big heavyweight 30 companies in the US, FTSE America, SX5E. For those who don't know, that's the European area, and I think that's important because we've got 3 European banks in that sector. And then we have the S&P Banks Index, which is a separate subsector of the S&P, just on US banks. When I say US banks, there's about 300 in there. So small banks, town banks, medium regional banks, district banks, you name it. But look at those numbers. Those are pretty good numbers. And I'm going sort of back to front here. And I said at the bottom there, who would have thought boring bankers would outperform the investment darlings? Because you go right to the top. And over a 5-year period, and I mean, I could choose 10 years and it would look very different, but 5 years since COVID, and I mean, I think everybody had a big reset in terms of thinking, in terms of attitude, and in terms of investment horizons. A net return of 226%. I mean, that is just phenomenal. That is, puts the others into the shade in terms of outright performance. This was updated as at the 14th of January. We produced a note, I think, in August, September last year, and the numbers were a little more flattering in terms of the underlying indices. They've come off a little bit. The so-called end-of-year rally, the Santa Claus rally, as I've referred to in my weekly wrap, that didn't really materialize, so a little bit of the numbers dropped off. Not a lot, but pretty much in the ball game. But a great stellar return from a sector that a lot of people regard as boring. But what are in those numbers? Okay, and they certainly demonstrate and illustrate a number of features and happenings that are going on in our lives. The health of I'm going to deal with this. The health of the deal-making sector. I'll come back to that. Consumer spending, okay, and debt. And investors tend to listen to banks' chiefs' investments statements very closely. These quarterly earnings reports, as I mentioned earlier. Now, let's deal with that last bullet point. A guy called Jamie Dimon heads up the largest US bank, which is known as JP Morgan Chase Manhattan. They had their earnings on Monday. They're not in this basket, but it gives you an idea for context. And he said, well, the health of the American economy, they felt between the next 6 to 12 months, was fairly resilient. Jobs had sort of settled, inflation, and we've had inflation numbers this week, yesterday, very important. CPI have sort of moderated, so it takes a little bit of pressure off the Federal Reserve in terms of there probably is not going to be an interest rate cut in January, that's for sure. And consumers are spending, which means that retailers, wholesalers, people like that, there's orders coming in, orders being filled. So that life is good, but you always have to take that as with a pinch of salt. Life is good, but what is going to happen down the road? But Jamie Dimon, when he speaks, certainly people sit up and listen, and his forecast was that their earnings, for example, his particular bank on the Tuesday earnings, was that they certainly beat earnings estimates. Their profits were up, their revenues were slightly down, but one of the things that they've made lots and lots of money on is deal making, that first bullet point. Now, deal making means mergers and acquisitions, interest rates are low, people can have access to cheaper money, and you can buy your competitor, you can refinance your debt, you can relook at your loans, etc., etc. So deal making goes from both a personal and into a corporate space. So there's activity there. At high interest rates, people sit on their hands because they're not prepared to pay those high rates to the banks. Now, obviously, banks are important because they're the oil that make the gears go around in this particular scenario, especially, and I'll show you in Europe in a later slide. It's very important that these deals happen. And certainly during the period up until, I would say, almost the end of 25 last year, Because of high interest rates, deal making was slow. But banks did very, very well. The financial sector did very well because they were charging high interest on overdrafts, okay, because of the interest rate. Now the interest rates come down, so they're not making that much money on deposits or lending and stuff like that, but they're making it on deal making. People are doing mergers, acquisitions. Let me buy my competitor down the road. Let me buy new equipment, etc. So they offset what they might have lost in interest in terms of revenues. And if you see what JP Morgan and specifically Goldman Sachs, because they reported this afternoon and they're in our basket, their biggest contributor was mergers and acquisitions, the corporate finance team. I mean, I think it was something like $2.3 billion. So we are talking major corporations, and this goes right across all four companies that we've chosen and that the banks approved. So very, very exciting slide there. Let's have a look at what the analysts think. Okay, so this is quite a busy slide. I'm just going to deal with the right-hand side of the slide very quickly. PEs are price earnings ratio. It's a technical term, but what we've done is we've got two columns there. We've got the columns of price earnings ratios for banks and price earnings ratios for context with the tech darlings, the NVIDIAs of this world, the Teslas, the AMDs, Advanced Micro Devices, Amazon. So those are big multiples. When you look at the PEs, the price earnings of banks, it's much lower, which means less volatility, less action, less up and downs. What is a price earnings? It's essentially, and we're going to do a Thought Leadership Thursday on this. Price earnings basically means what are you prepared to pay for $1 or €1 or £1 of that company's earnings? So for Goldman Sachs, they're saying, well, you're going to pay 18.6 times for $1 of that company's earnings. So that's, it's quite a lot. Look at Tesla, 302. Now that creates a concern in terms of, is that company actually worth paying that sort of money? Is it being fueled? Is the momentum of that price being fueled on sentiment, or its earnings reflecting that it can actually hold that balance sheet together? So this is what I call the fundamentals. We mentioned it early, looking at the fundamentals. Are the fundamentals solid? Forget about the fad, forget about the opportunistic tactical opportunities, look at the fundamentals. So that's sort of the price earnings. You can see that banks are lower, they're less sexy, they're less fizzy, but they do the job. Goldman's had their report this afternoon. I just finished reading it in the car on my phone between traffic lights. They've come out with excess profits. Their revenues are down, very similar to JP Morgan, but their earnings, their profits are up basically on the back of this mergers and acquisitions. It also goes in line. The two other big banks that came out this week was Bank of America and Citi. Those are the other two very big banks in the States. Same sort of vibe, but everybody, those CEOs are all saying it's a resilient economy. Midterm elections are coming in the States, particularly. For example, these are all American banks reporting because we haven't had the Europeans. You can see between the 6th and the 9th of February, we're going to have a slew of reports from those banks. But it's very positive from that side. And it's also very positive if you look at under Goldman's, it says hold. Barclays, it says buy. Commerce hold. What does that mean? So the analysts these are the sort of Wall Street analysts who operate and examine both from a quantitative and a qualitative perspective. Should they be suggesting to their clients that they should buy or sell these shares? This is not the elixir of youth. This is not the panacea of the world's ills. They can get it wrong, absolutely. But there is a lot of work and effort and time that goes into this. So, buyers obviously, well, they see this, they still value. If you're a growth investor, invest in it now. Still accumulate the shares. What does hold mean? And hold really is a consensus feeling or opinion of a mixture of buy, sell, and hold. But it equates to hold as sort of the midterm median. And essentially, it's around the fundamentals are right, but maybe there's been a sharp increase or decrease in pricing, and they need to validate whether the earnings or not are going to hold those companies together. So as you can see, those earnings reports are coming out, and they will validate that. So hold means, you're not going to rush out and spend your whole pension fund in terms of buying Barclays Bank or Commerzbank or anybody else. It's, again, as I said earlier, when there's opportunities, let the dust settle, have a look, do the research, and then quietly go in. Cashbox is not a stock picker. We're looking for quality companies that can pretty much trundle along. So who remembers this? Okay, look at the big circle. That was the great financial meltdown of 2008, 2009, because essentially banks started it. They were the litmus of what caused pretty much the global financial system to crash. This is representative of the European banking stocks. So I'm showing you what was good, 226%. This is over, as you can see, this is over almost a 25-year period. So it's not a 5-year period where you got the stellar results. So there you can see that big bubble. That was like, you're probably talking about a 60 to 70% decline in a fairly long period of time, from 2008 through to the end of 2009. So it was a long, dark period. It was because banks had not been regulated properly. The oversight was not right. There was all sorts of toxic assets that had been mortgaged, leveraged, deleveraged, multi-leveraged, et cetera, et cetera. One of the biggest casualties in the States were the biggest mortgage companies, as well as one of the largest and most august stockbroking, Lehman Brothers. But you can see what happened. Following that, banks were, and there's a slide to show it, the banks got their acts together. Well, they were forced to get their acts together. And then, again, a little bubble in 2020, okay, where we had a little thing called COVID, which we all thought we were going to die and run out into the streets and disappear. We survived that. It was a very different experience to what happened in 2008, 2009, because that was a long decline. This was a very short decline in terms of a fortnight or so. But the viciousness of the decline really, everybody's attention was hyper focus and laser focus. But as you can see, subsequent to that, there's been this very solid, this is the European banks, very solid return to form. And just to give you an example, this is a more up-to-date slide from probably the beginning of 2025. And that line was interrupted in April. Okay, we should know why, because the headline says that we were tariffed. The world got tariffed or terrified. But certainly, that was a big shock to the system. The rule book was torn up, thrown out the window by the American administration on the Rose Garden with Mr. Trump and his whiteboard, and people were terrified in terms of this is the end of the economic relationship and making money. That actual decline, I've done the maths, was around about 16%. Now, just bear that in mind, 16%. That was a huge, huge event in the last 12 months. 16% decline, and Jill will point out that we have got a 45% degradation decline allowance built in. So, that we wouldn't have felt this in terms of our capital protection. And that is why notes have this unique ability that we run to term, and we've got this long, deep protection built into the contracts that you take out. So since then, you can see there's been this like super nice sort of incline. A lot of people are concerned that banks have run too hard, run too fast, et cetera, et cetera. Having said that, as I mentioned, the banks are actually gung-ho themselves in terms of, well, the next 6 to 12 months, earnings are good, profits are good, and in this environment of a well-regulated jurisdiction, there's lots of opportunity to make money. How did they get this right? Okay, because this is very important, is doing the fundamental analysis of what banks had before 2008, 2009, which, as I mentioned, was all this toxic stuff, okay? All this toxic, primarily mortgage properties. And you can see that the capital ratios, in other words, what the banks had to keep on their books for their clients, in other words, if the client wanted their money, was pretty low because they were lending it out everywhere. They were spending it everywhere. There wasn't really a sort of a handcuff to say you need to keep cash in the bank in case your client wants them loot. And 2008, 2009 came along. We saw what happened. And the regulators globally said, right, banking, if you want to keep your license, you've got to have good assets, sell off the rubbish, get rid of the toxic stuff, have good assets that are actually valuable for your clients, and keep correct liquidity levels. And you can see from the period 2010, once we went through this wake-up knee-jerk reaction, right the way up to 2019, 2020, that banks have maintained this level of high liquidity, high asset class within their portfolios. And what is important, and we'll see it in one of the last slides, is the how European assets differ from US assets. Okay, because that's why we've chosen again a preponderance of European Union based banks. What's obviously also important is I mentioned earlier, how do banks make money? They generally make it out of interest rates. They're tied to interest rates. And banks have this relationship with economics that if the economy is going well, banks are going well. If the economy is not doing too well, banks aren't doing too well. Not completely 100% true. So what you see is on the left-hand side, back to the financial crisis, back to the scar, interest rates, the blue line came piling down because they had to do that to keep the ship floating. And pretty much up until COVID even, 2020, rates were at an all-time low. So what that meant for you and I as depositors, as investors, there was nothing in cash. Even today, banks offer very, very little, even though rates went all the way up. If you look from sort of 2022, there was this huge increase in rates around the world to combat inflation. Because what you have, if you have free cash, and that was what quantitative easing, what they called, where they pump trillions of dollars into the global economy, and I'm talking dollars, but it was euros, it was pounds, it was everything. Every currency was pumped in to keep businesses and economies and countries afloat. And so there's a lot of loose cash floating around the world at the moment, and it's looking for a home. It's founded in stock markets, obviously, because interest rates started ratcheting up, and they sort of tapered off in 24, and now they're coming down. So some clients who were sitting in cash are now starting to look for a better home because they're starting to lose on a month-to-month basis in terms of the yield that they're getting, that the banks are offering. Banks aren't charities. They're going to hold on to what they can, and they're going to give you as little as possible in terms of your deposit rates. So quite important in terms of having a look at that, and then matching it to the next slide, which is really, I've called it crossing the Rubicon. And here you go. So these are this is a sort of a 10-year chart. It literally matches the US versus the European Union banking sectors. These are two specific banking indices. Okay, the brown line is the European guys, and the blue line is the Americans. And you can see they pretty much looks like a mirror image. They pretty much track each other up and down all the time. And then somewhere along the line in 2023, the Europeans broke out, and for the first time in many, many years have outperformed the Americans. So that gives, us at Cashbox the opportunity to say, well, hang on, is this a sector that's going to continually outperform? Is it currently outperforming? Is there a short-term opportunity here? Do we put 3 American banks in, or do we put 3 European banks? So there's some of the logic. And again, go to the rationale. It's more granular. It's a little bit deeper. But this sort of visually shows you why there's a preponderance of European banks. And in the next couple of slides, it's actually spelled out to you. But that was quite a crucial point. They're pretty close together at the moment. And obviously, interest rates are very important. But there are things happening in the States that beg your pardon, there are things happening in Europe that also are pushing us towards European banks. And here are some of them. Very, very strong financial fundamentals, compelling valuations. We showed you some of the price earnings ratios, which are really, as the appetite for those is great. And they've got very disciplined capital management. The European Central Bank and the regulators around Europe are spot on in terms of making sure that the right assets. I showed you about the SCAR slide where they had to get rid of everything. The European assets are probably a better quality than some of the assets that are held in American banks. There's been a lot of consolidation. One of the major banks that is busy on the prowl at the moment, the Italian Wolf, UniCredit, we've included it in 2 of our previous notes last year. It's doing a lot of acquisitions. It's buying up smaller competitors in different countries. It's becoming a huge regional and will probably become a huge global player. Its share price has done phenomenal things as well. But it does a lot of this mergers and acquisitions, M&A. and a lot of this takeover sentiment, because rates are cheap. If they haven't got the cash for themselves to do what they need to do, they take it from from other banks or from themselves, and they lend it out against through their investor base. So rates are cheap at the moment to borrow. So I think importantly, from a sort of a more granular, it costs the banks to do stuff. And I think importantly, one thing we can control is costs in our own life. As I mentioned on a call to some Australians this morning, we can determine, are we going to go skiing 3 times a year or once a year? Are we going to buy X amount of groceries a week, or buy once a month? You can control those costs. There are some extraneous costs and external costs that you can't control, but it'd be taxes, import duties, price of fuel, etc. That's beyond your control. What you can control is how much you are spending. And certainly the cost of equity for banks, how much they're going to spend, is that it's going to drop. So if you're dropping your costs, inevitably means that it's going to reflect on the other side of the balance sheet in terms of from the liability side, you now go to the profit side. So what they weren't spending on costs, they're now allocating in terms of let's put this money to work and make some profits. One of the really big opportunities is the AI trend. Now that's a bubble. They're calling it a bubble. That's you saw some of the valuations of some of those tech companies. There's been an absolute binge in terms of capital investment into this mega trend, and it's a trend that's not going away. But obviously what has to happen at some point is that the enablers who are pouring money into the trend have to be repaid in terms of profits. So your Googles and Metas and Alphabets and Microsofts, who are pouring millions and trillions into the AI trend, need to actually have the trend monetized. So by that, what I mean is that it gets to a point where you as a business owner say, fantastic, if I have this learning language model, that I can put it into my pharmaceutical business, or I can put it into my engineering business, it's going to save me a lot of money, but I have to pay for it. If you haven't got the cash, you're going to go to the banks. So the banks could be a massive benefactor or beneficiary of spending into the AI space. And some of that is implied in the trajectory in that last sort of footnote, is that there's still upside, in the pricing of these companies. A lot of these companies almost at all-time highs. But I could have said this 6 months ago when we launched a product in August and September in banking as well. Prices were high then. So the movement, if you take the movement in terms of fundamentals, you take it in terms of sentiment, you take it in terms of some of the leaders of these global companies, is that there's still room and there's still energy for the banking sector, the financial sector, to move still strongly forward. And AI is simply one of those coattails that they can ride on very, very strongly. If we go to the last slide the second to last slide that I'm presenting on, before Jill tells you the exciting stuff, this is something that I value and I think everybody should take on board. You've got to look at the valuation of a company and its capital strength. Valuation is absolutely central as I put. And if you look at what European banks are trading at, they're actually still at a discount compared to other sectors, maybe in the tech sector, etc. They're catching up because they've done so well. But from a valuation, from a fundamental analytical perspective, there is still discounts to be had. Okay, their capital strength, they've got great asset quality, very stable. They haven't got a bad book loan, they haven't got toxic assets. They're not having to make provisions for things to go wrong. They've got rid of that. They've got rid of that after 2008, 2009. Loans have been, low, but loans have been low because of high interest rates. Banks make a lot of money on that. They're now coming through because of low interest rates. People are wanting to spend. And I think certainly if you look at the rationale, I used 3 companies that I value: JP Morgan, Goldman Sachs, Schroders, and Rothschilds. Very sage. I like to see where their money is flowing. And their perspective on tier 1 European banks is that, and that's it, excellent capital management, selective acquisitions, consolidation, avoiding poor deals. That should go through any business. That's in a little bit more detail in the rationale. I would suggest you read it for a little bit more detail. And yeah, I think the corporate activity, is where people are really starting to make money now. I think, you probably see some smaller banks disappear in Europe and in the States, in terms of the banking sector that we're looking at. But that lends to the credibility and the strength and the dynamics of the banking sector. So yeah, in conclusion, resilience is important. It's capital strength, and it's a sector that's often overlooked by clients who say, well, hang on, I'm following the latest. I've seen this as really shooting through the roof. It needs to be investigated from a fundamental point of view, from a tactical point of view. And I pretty much sum it up in the next slide, which you'll kindly got for me. And I call it behind the moat investing. It's the old medieval castle with a moat, which hopefully made it more difficult for intruders or invaders to get into your wealth and your castle and your everything else, your stores, which basically gives you they talk about an economic moat in companies. And I think that's what banks have got. They've got this economic moat. They can profit both in downswings in interest rates and also in upswings in interest rates. And hopefully some of the examples that I've alluded to in terms of corporate activity, mergers, acquisitions, consolidation, etc., lends credibility to that view. But again, from a defensive opportunity, banks are generally a defensive sector. So I just want to also thank Graham very, very much for bending and arm wrestling BBVA's arm down to 14%, because when we started off, it was 13.2, and they seemed a little bit sticky on moving. But we gave them a great, inventory in terms of what we wanted to. And we're delighted to have that 14% on offer. So with that, I'm going to hand over to Jill, who'll give you all the exciting stuff, and Chad.
Okay, thank you, Andrew. It was really, really interesting. So what I'm going to do is just run through the terms of the note, then just do some examples of how it works, and then we can answer any questions. So starting out again, Andrew said BBVA is our issuing bank, and that is their ratings. Moody's is A2 and S&P is A+. The coupon again is 14% per annum. The term is 4 years at a maximum. That is assuming that the note does not autocall. That is the longest period that the note can run for. The income trigger is set at 55% of the initial level. So that's a really, really deep level that even if those stocks drop by up to 45%, you can still get your coupon paid out. There is the autocall trigger built in, and that's your early maturity opportunity, which starts from 12 months, and that is set at 95%. So even if those stocks drop by 5%, it still has the opportunity to mature early. Reference basket, Andrew's gone through quite comprehensively, and then our capital protection is also set at 55% of the initial level. And I'll just go through a quick slide just now just to show you how that works. From an availability perspective, the 29th of January is the closing date for this note, or full subscription. We've had quite a number of notes last year that didn't make it nearly close to its final date because the subscription was taken up beforehand. And then in terms of your minimum investment, you're looking at from $10,000 upwards. So what I'm going to do now is just going to illustrate quickly how the note works in practice. I'm also going to walk you through the key features and then go through an example. So in terms of the various parts of the note, the start value of the underlying stock of the underlying stocks is going to be set on the 2nd of February, and then at the various observation dates, the performance of each of the underlyings is going to be measured relative to the start price. Your income trigger, as I said, is set at 55%. This means that as long as the underlyings are at or above their start price, 55% of their start price on an observation date, the coupon is going to be paid. As long as they remain within this range, the quarterly income will continue to flow. From the 4th observation, the autocall or the early maturity feature comes active, and then the autocall trigger is set at 95%. meaning that if all the underlyings are at or above 95% of their start price on any observation date, from this point onward, the note's going to mature early and return capital together with your relative coupon. We do have a memory feature built in, and that is included there so that if there is a period of temporary underperformance, if one of the or more of the underlyings fall below the income trigger at an observation date and the coupon is missed, the coupon isn't going to be lost. Once all the underlyings are back above the income trigger at a later observation date, any missed coupons are going to be paid out in full. Finally, the capital protection barrier, which is also set at 55% of the start price. If the note doesn't auto-call early, it will run through that to that point, and a measurement will be done as long as those stocks are at 55% of their start value or above, you're going to receive your full capital back. In the event that the underlyings are below that 55% level, then your capital repayment is going to be linked to the performance of the lowest performing stock. And that's going to happen on final observation. Then, now we're going to just run through a quick example. So we start off, the note issues at the first observation date, and all the underlyings are above the income trigger. As a result, your 3.5% coupon is paid to your trading platform account. At the second observation in this example, one of the stocks has fallen below its start price, but it's still above the income trigger. So again, your coupon is paid. By the third observation, the same stock has now fallen, for example, down below the income trigger. However, because it includes the memory feature, the coupon isn't lost. It's simply put on hold until all the underlyings are back above the income trigger. Your next observation date, you can see here, your underlyings are once again above the income trigger. Then at this point, your previously missed coupon is paid out together with the current quarter's coupon. And it doesn't matter how many coupons are missed. Once your underlyings go above that payment trigger again, all the coupons will be paid out. Then at a later observation, you can have a look here. The underlying basket is above the Autocall trigger and the note matures early. And then your final coupon is paid with your full capital. If the note doesn't autocall and instead runs the full term, then your capital protection barrier is going to apply at the final observation, as long as those underlyings remain at or above 50% of their start value. Another sheet that we love that comes as part of the fact sheet, we love this one because it's a single glance. You can see all the key details of the note. Your page sets out the total number of observation dates, the specific dates on which those observations are going to occur, the payment dates, which are when your coupon payments will leave BBVA for your trading account, and when, if the note does autocall or at maturity, your capital is going to be released. So those are the dates that you'll have. And it also clearly shows the income trigger level for each observation and the autocall trigger level. You're going to notice that for the first 3 observations, the autocall trigger is marked as not applicable. That's because the autocall trigger only becomes active after 12 months, and that corresponds with the 4th quarterly observation. From that point onward, the note has the potential to mature early at each subsequent observation after that. And then at the bottom of the page, you're going to see the final observation and your capital protection barrier set at 55%. And then for those who haven't done so previously, how would you invest in the note? You will need, first of all, access to a trading platform, a custodial platform, which holds the contract on your behalf. You can't invest via a bank account. We are platform agnostic, but if you do need some guidance, drop us an email. We can help you with that. For those of you who already have your platform, let us know that you would like to participate, and then we will provide you the ISA number, which is that unique identifier for this particular note. While you can draw a report from your trading platform, Cashbox Global provides quarterly reporting to keep you informed about your investment. Your trading platform can see the actual value of the underlying stocks, but it can't see the contract, which is why we provide that to you as well. And then if you would like a refresher on structured notes, we are happy to provide any kind of training that you need or support, because it's very important for us that investors understand how their investment works. Then remember, last but not least, your closing date for your funds to be cleared and your instruction to issue to your trading platform so that you can make it in time.